The Contrarian Playbook. Introduction. Every legendary contrarian investor loves a good crisis. When the broader market flees a stock, the price plummets, and a massive neon sign lights up screaming, discount. But now that we're in July 2026 and heading into the second half of the year, global markets are an absolute minefield. What looks like a once-in-a-decade bargain is, more often than not, a financial black hole. The core problem with mainstream contrarian content is that it oversimplifies the game. It tells you to buy low PE ratios blindly. This video discards that misleading advice. Today, we're laying down a concrete rule. A stock is only an undervalued gem if its depressed valuation is driven by temporary outside headwinds, paired with smart management and a protective economic moat. If it lacks these, it is a structural value trap destined for bankruptcy or wiping out your investment permanently. To execute this safely, an investor must apply a simple, step-by-step screening process that filters by trailing returns, beta, dividend per share, DPS, and operating margins. Think of it as your financial radar for the rest of 2026. 2. Framework core, gem versus trap diagnostics. Before scanning global markets, we must establish our analytical framework. How do we objectively separate the gems from the traps? We look at three primary pillars: structural industry shifts, balance sheet integrity, and return on invested capital. First, identify why the stock got so cheap. A genuine gem suffers from short-term cyclical or macroeconomic pressure, think temporary supply chain blocks or central bank rate hikes. Conversely, a value trap suffers from a dying industry. The business model is shrinking, or technological disruption is making its core product obsolete. One is a bruised winner, the other is a falling knife. Second, audit the balance sheet. A low PE ratio means absolutely nothing if the company is drowning in floating rate debt. In today's persistent high interest rate environment, look at the interest coverage ratio. If the company requires more than 30% of its operating cash flow just to service its debt, its cheapness is an illusion. Finally, look at return on invested capital, or ROIC. A gem maintains a stable or recovering ROIC despite low stock prices because management handles capital efficiently. A trap features a decaying ROIC, meaning the company is actively destroying value every time it reinvests a dollar. 3. Regional application, U.S. markets. Let's apply this directly to the geographic regions shaping our mid-2026 portfolios, starting with the United States. Our screening method focuses on firms with suppressed 3-year returns due to short-term cycles, but possessing low volatility, beta, and strong operating margins. Gem case study 1, Devon Energy, NYSE, DVN. 3-year total return, minus 12.4%, beta, 1.15, annual DPS, $2.44, operating margin, 26.8%. Why we picked it: strong variable dividend payouts and cash generation despite lower oil cycles. Key risk: high vulnerability to global energy demand destruction. Gem case study 2, NextEra Energy, NYSE, NE. 3-year total return, minus 4.8%, beta, 0.68, annual DPS, $2.06, operating margin, 29.5%. Why we picked it: a defensive utility giant oversold due to higher interest rates but insulated by massive structural backlog and green infrastructure. Key risk: delays in grid connection approvals. Value trap case study, Intel Corporation, NASDAQ, INTC. 3-year total return, minus 38.2%, beta, 1.25, annual DPS, 50 cents, operating margin, 3.2%. Why it's a trap: its low PE masks an eroding operational margin, a collapsing cash floor, and multi-billion-dollar foundry execution delays. Key risk: persistent market share loss to fabless design competitors. Regional ETF selection, Vanguard Value ETF, NYSE VTV. 3-year total return, plus 18.6%, beta, 0.88, annual DPS, $3.12, average operating margin, 18.4%. Why we picked it: selected to capture broad-scale U.S. value normalization without concentrated single-stock operational risks. Key risk: prolonged stagnation in value sector multiple expansion. 4. Regional application, United Kingdom markets. Across the Atlantic to the United Kingdom, where Brexit legacy issues and weak domestic growth have discounted the entire index, making deep screening vital. As we look forward from July, these deep discounts hide completely different corporate realities. Gem case study 1, SHEL PLC, LSE, SHEL. 3-year total return, plus 22.4%, beta, 1.02, annual DPS, $1.38, operating margin, 15.2%. Why we picked it: its cash-generative integrated gas segment supports aggressive share buybacks, rendering its valuation absurdly cheap relative to U.S. peers. Key risk: accelerating European climate litigation. Gem case study 2, GSK PLC, LSE, GSK. 3-year total return, minus 2.1%, beta, 0.55, annual DPS, 62 cents, operating margin, 22.8%. Why we picked it: oversold due to historical product liability lawsuits, yet its underlying vaccine pipeline remains highly profitable with rock-solid operating margins. Key risk: clinical trial failures for key phase 3 candidates. Value trap case study, Vodafone Group, LSE, VOD. 3-year total return, minus 29.4%, beta, 0.82, annual DPS, 5 cents, reduced, operating margin, 8.5%. Why it's a trap: a classic trap with high capital expenditures, decaying consumer pricing power, and an unsustainable debt load disguised by an artificially high trailing dividend yield. Key risk: chronic failure to consolidate hyper-competitive European telecom markets. Regional ETF selection, iShares Core FTSE 100 UCITS ETF, LSE, ISF. 3-year total return, plus 14.2%, beta, 0.90, annual DPS, 38 pence, average operating margin, 14.8%. Why we picked it: used to play the structural UK undervaluation while gaining immediate diversified exposure to international mega caps. Key risk: strict reliance on global macro cycles rather than UK domestic recovery. 5. Regional application, European markets. Let's examine continental Europe, where macroeconomic stress highlights severe divergence between structural losers and resilient premium cash flows. GEM Case Study 1, ASML Holding, AMS, ASML. 3-year total return, plus 5.4%, beta, 1.30, annual DPS, $6.80, operating margin, 31.2%. Why we picked it, cyclically depressed due to a temporary chipmaker spending pause, but it is an absolute gem due to its monopoly over extreme ultraviolet lithography machines. Key risk, aggressive export restrictions into Asian markets. GEM Case Study 2, Total Energies SE, EPA, TTE. 3-year total return, plus 19.8%, beta, 1.08, annual DPS, €3.12, operating margin, 16.5%. Why we picked it, selected due to its dual exposure to low-cost African oil assets and growing European electricity grids, trading at a steep discount to fair book value. Key risk, unexpected local nationalization of foreign extraction sites. Value trap case study, Volkswagen AG, Zetter, Val 3. 3-year total return, minus 34.6%, beta, 1.22, annual DPS, €9, operating margin, 6.8%. Why it's a trap, avoid it as a trap. The superficial low valuation is heavily compromised by massive legacy labor structures, declining market share in China, and an software pipeline fraught with bottlenecks. Key risk, permanent destruction of historical European automotive export channels. Regional ETF selection, Vanguard FTSE Europe ETF, NYSERCA, VGK. 3-year total return, plus 11.5%, beta, 1.05, annual DPS, $2.15, average operating margin, 13.9%. Why we picked it, deployed to capture cyclical industrial normalizations across core Eurozone economies. Key risk, euro depreciation driven by divergent ECB monetary policy. 6. Regional application, Japanese markets. Finally, we turn to Japan, where the playbook going forward must prioritize the Tokyo Stock Exchange's capital allocation reforms to separate true reformers from permanent value destroyers. GEM Case Study 1, Mitsubishi Corporation, Taiyo, 8058. 3-year total return, plus 84.2%, beta, 0.85, annual DPS, 110 yen, operating margin, 7.4%. Why we picked it, a prime Warren Buffett favorite, a highly diversified trading company that aggressively buys back shares and liquidates non-core assets. Key risk, rapid slowdown in global manufacturing raw materials. GEM Case Study 2, Sony Group, Taiyo, 6758. 3-year total return, minus 6.5%, beta, 1.12, annual DPS, 90 yen, operating margin, 11.1%. Why we picked it, a temporary valuation dip created by game console cycles, but a structural gem given its deep intellectual property moats across music, movies, and image sensors. Key risk, intense competitive pressure in mobile entertainment formats. Value trap case study, Nissan Motor Company, Taiyo, 7201. 3-year total return, minus 22.1%, beta, 1.18, annual DPS, 10 yen, operating margin, 3.5%. Why it's a trap, compressed operational margins, lack of distinct hybrid technology, and a frozen management structure unable to react to Chinese electric vehicle pricing wars. Key risk, severe operational liquidity crunches. Regional ETF selection, iShares MSCI Japan ETF, NYSERCA, EWJ. 3-year total return, plus 21.4%, beta, 0.92, annual DPS, $1.18, average operating margin, 9.8%. Why we picked it, utilized to capture systemic corporate governance transformations across Japan's mega-cap landscape. Key risk, severe currency risk if the yen experiences unhedged volatility. 7. Capital sizing and asset switching, the missing pillars of Practos. Crucially, a common flaw in modern contrarian literature is focusing 98% of all content on the buying decision. In practice, long-term wealth compounding is entirely governed by position sizing and asset switching. You must size your contrarian buys dynamically, keeping them between 0.5% to 2% of your total portfolio based on a strict composite score of your fundamental conviction and the underlying balance sheet leverage. Never put too much money into a single depressed equity. Furthermore, delete the word selling from your vocabulary. Instead, frame every exit as a strategic asset switch. If you own an asset like Devon Energy that has run up to its peak, do not simply exit to cash. Evaluate the switch. Are you shifting that capital into a deeply depressed, low volatility gem like GSK? Viewing your actions through the lens of continuous capital rotation removes the paralyzing emotional block of trying to perfectly time market peaks and valleys. This dynamic rotation mindset is exactly how you survive and win in volatile H2 2026 conditions. 8. The pre-purchase checklist. Before risking a single dollar of your capital on any global stock, you must run this definitive, non-negotiable pre-purchase checklist. The catalyst audit. Can you clearly identify why the asset is currently cheap? It must be driven by a temporary macroeconomic headwind rather than a broken, dying business model. The debt coverage buffer. Check the trailing interest coverage ratio. It must safely exceed 4x for standard industrial equities. The mode test. Does this firm possess pricing power or an asset base that cannot be easily replicated by a technological competitor? Think of it like how Google Sheets failed to displace Microsoft Excel. The management alignment verification. Look at insider transactions and capital returns. Management must be actively finding value traps through share buybacks or maintaining a robust dividend per share buffer. 9. Conclusion and synthesis. To wrap it all up, true contrarian success is never achieved by blindly buying what is cheap. The market is highly efficient at pricing structural decay. As we navigate the macroeconomic realities of July 2026 and look toward 2027, your defense mechanism against value traps must be absolute. Avoid dying industries, reject over-leveraged balance sheets, and disregard management teams that hoard unproductive cash. Instead, hunt for high-return operators, protected by wide economic moats, whose valuations have been temporarily suppressed by short-term market anxiety. That is how you secure an undervalued gem. If you want to master deep financial analysis and protect your portfolio from value traps this year, hit that subscribe button, drop a comment with the stock you're analyzing right now, and I'll see you in the next breakdown. Stay analytical, stay disciplined. Farewell. Disclaimer, I am not a financial advisor. This video is for educational and entertainment purposes only. Always perform your own due diligence before investing. Farewell. This is the stock market.